Financial Forecasting, Chapter 4, Part 1. Chapter outline focuses on financial forecasting and a firm's strategic growth, 3 financial statements, using the percent of sales method, methods to determine the amount of new funds required in advance, and factors that affect cash flow. So financial forecasting is the ability to plan ahead and make necessary adjustments before actual events occur. Both focuses on the outcome of a firm through external events, might be a function of both risk-taking desires and ability to hedge against risks with specific planning. It answers questions such as, is there no growth, or is there a decline in growth? Or are none of these a primary cause of shortage of funds, or is there a cause of shortage of funds that we're trying to address here? A comprehensive financing plan must be developed for significant growth within all companies. Constructing pro forma statements. Pro forma or projected financial statements enable a firm to estimate its future level of receivables, inventory, payables, as well as its anticipated profits and borrowing requirements. These statements are often required by bankers and other lenders as a guide for the future. A systems approach to develop pro forma statements consists of constructing income statement based on sales projections and the production plan, translating it into a cash budget, and assimilating all materials into a pro forma balance sheet. Now we're going to talk about the development of pro forma statements. And here's a breakdown of what you need to start a pro forma statement. Sales projection into a production plan, all the way into pro forma income statement. From there you build a cash budget, any other supportive budgets you might need, and then from there use a prior balance sheet to construct your pro forma balance sheet. Pro forma income statement provides a projection on the anticipation of profits over a subsequent period. 4 important steps include establishing a sales projection, determining production schedule and the associated use of new material, direct labor, and overhead to arrive at gross profit, and computing other expenses, determining profit by completing actual pro forma statement. Establish a sales projection is the first thing you need to do. Let us assume Goldman Corporation has 2 primary products, wheels and casters. Here's table 4.1 to illustrate. You can see you have 1,000 wheels, 2,000 casters with sale prices of $30 and $35, producing sales revenues of $30,000 and $70,000 with a total of $100,000. You need to determine a production schedule and the gross profit from there. Number of units produced will depend on beginning inventory, sales projections, and desired ending inventory. To determine the production requirements, you need to know your units, plus your projected sales, plus your desired ending inventory, subtract your beginning inventory, and then equals your production requirements. And then your stock of beginning inventory from Goldman Corporation shows these items in stock below. You have 85 wheels, 180 casters, $16 cost of wheels, and $20 cost of casters. So you can see your total value is $4,960. The production requirements for 6 months also. Your projected unit sales will be 1,000 wheels, 2,000 casters. Your desired ending inventory will be just about 100 wheels and 200 casters. And you need to assume represents 10% of unit sales for the time period. Beginning inventory, obviously we know that already, so we take that out, and that gives us number of units that we would need to produce. Unit cost, the cost to produce each unit. We have that as well. Materials is $10 per wheel, $12 per casters, 5 labor, 6 casters, overhead is 3 and 4, and total is 18 and 22. Your total production cost can be added in there as well, it's just a total cost of $62,710. So, and that will end our video for part 1.